So let us say that I ask you to close your eyes and I give you a piece of mango to eat, okay, without telling you what fruit it is. So you take the piece of mango, you eat it. Now there is a very high probability that if I ask you what fruit you are eating, there is a very high probability that you will say it's a mango. Now, why is that? Because in the past, you have eaten enough mangoes or you have eaten enough different types of mangoes to understand what does it taste like. Okay, so there is a memory of that taste somewhere in your system. You know that a mango will taste like this. Okay, so even if I ask you to close your eyes, give you a piece of mango, you eat it, you can instantly know that it's a mango because your past experience, okay, allows you to identify that taste. Now, what has mango got to do with trading? So I'm using this example to convey a very simple idea to you. Never buy a stock that is extended in price. Okay, let us look at an example. I will show you a chart to help you understand what I am trying to convey here. And it's a very important idea. Okay, so let's look at the stock of Prudent Corporate Advisory. First, let's try to understand why was this stock on my watch list. Then we will come back to that mango example. Okay. So currently, the market is on. It's been around 3 hours. The market is live. The stock has broken out. It opened above the yellow band. Okay. And let us discuss this stock. So, how do we look at a stock? We do three kinds of analysis: comparative analysis, technical analysis, fundamental analysis. So let us first do comparative analysis. Comparative analysis, what do we look at? We look at relative strength of the stock, we look at relative strength of the industry group, and we look at institutional demand. So since this stock is from India, we have this data on MarketSmith. So let me take you to MarketSmith. Okay. So I will go to MarketSmith. I will sign in. So I am a customer of MarketSmith. I am a regular subscriber there, premium member. So let's go to Prudent Corporate Advisory Services. So yesterday night, I put this stock on my watch list. I want to give you the reason why did I do that. Okay. So I click on this. I click on consolidated. Let's have a look at this stock. So master score is 80. Anything above 60 is very good. Okay, master score basically combines technical and fundamental factors to determine a score for any stock. That is what MarketSmith is doing. EPS rating is 95, super. Price strength is 88. Anything above 80 is very good. Accumulation distribution rating, which is institutional demand, is A rated, which is very good. Well, the group rank is 67. This is a problem. Okay, we want the group rank to be 40 or less than 40. So let us have a look at the industry group rank, whether it has improved or not. Sorry. So it is finance, investment management. So let us sort this by alphabetical order. Let's go to finance, investment management. So 67. So 6 months ago, it was 37. Now it is 67, which means we have a problem. The industry rank is not that great. Okay. Or the industry rank has not improved. In fact, it is worsened. Okay. So price strength is great, institutional demand is great, but the strength of the industry is declining. Now, William O'Neill has once said that more than 50% of the move in any stock is attributable to the industry. So, for example, if the stock goes up 20% in a month, so 10% of that 20% is attributable to the performance of the industry. Now, in this stock, the industry rank is poor. So, which means when we do our comparative analysis, we can say See, this is about comparative analysis. When we do comparative analysis, we can say that the stock is weak. Okay. So, comparative analysis, we have a weak stock. Let's come to technical. Well, technically, if we ignore today's candle, technically it looks strong. You see the blue dot here. Blue dot represents the 52-week high in the relative strength line. This is the relative strength line. So the stock has never been more strong compared to the Nifty 50 ever. Okay, it was strong here, but now after many months, it has again become strong. So the blue dot inside the base is an extremely positive sign. Okay, so technically the stock is strong because, just a second, we'll go back to the chart. See, blue, green, red, the price is on this day, at the close of this day, the price is above the 50-day moving average, which is the blue line, which is above the 150-day moving average, which is the green line, which is above the 200-day simple moving average, which is the red line. So it's a strong uptrending stage 2 stock. Next, it has more than 10 candles in the base. So you start counting from this candle. Next, it has 4 points in the base. In fact, more than 4 points. So 0.1, 0.2, 0.3, 0.4, and 0.5. Okay. So it has more than 4 points in the base, more than 10 candles in the base, and blue, green, red. This is the basic criteria that we look for. So comparatively, the stock looks weak. Technically, the stock looks strong. What about fundamentals? Look at this. Do you see red here? Do you see red here? No. So past several quarters, okay, the stock is showing double-digit growth in sales and in earnings. Moreover, return on equity is more than 17%. I have not looked at margins. Just have a quick look at margins. So you go down, you go to after-tax margin 2024. So see, 2018, 6 years ago, the margin was 11%. Now it is 17%. Has the margin expanded? Yes. So not only is the company growing its sales at double digits, it is also able to keep more of that improved sales as profit. So you can notice if the sales is expanding and the margin also is expanding, imagine what kind of impact it is going to have on the earnings. So I always say the earnings is not that important. What is important is the sales expanding and is the margin expanding? It will automatically show up in the earnings because earnings is nothing but sales multiplied by margin. Okay. And you have a return on equity of more than 17%. So it's a fundamentally strong stock. So again, we have a stock which is technically and fundamentally strong and comparatively weak, which means it's a fabulous opportunity. It's a stock which is not, the market has not yet realized the potential of this stock, or the market has not yet realized the potential in the industry group. Okay. So whenever the industry starts to strengthen, a lot of money might come into this stock because this stock displays technical and fundamental strength in that particular industry group. Okay. So there is big potential in the stock. So that is why the stock was on my radar. Now let us look at what happened. On this day, I was expecting the stock to open below the yellow line, cross the yellow line on high volume. Now high volume came, but the opening price itself is above the yellow line. So whenever the opening price is above the yellow line, at least the first yellow line, I don't buy the stock. Now why is that so? Because the stock is extended. I want it to open below the yellow line and then start moving, crossing the yellow line. If it opens above the yellow line, it's an extended stock, especially if it opens above the yellow band. See, the next yellow line is 1% above the first yellow line, okay, which is the buy point, which is point number 3 in the base. So my buying range is between these two yellow lines. If it goes above the yellow line, it's an extended stock. If it is below the yellow line, it is a premature stock. So I want the stock to open below the yellow line and start crossing the yellow line. That's a proper way to enter a stock. I don't want to buy extended stocks. Why is that so? Because a stock could open above the yellow band. It could be early morning push, and then when you buy, it might start to come down. So what happens is, early morning, whatever orders, aftermarket orders were put, they get executed. The stock goes up, and then it fizzles out. So the retail player starts selling the stock. Or sometimes what happens is the stock opens very strong, and a lot of institutions are in the stock. They get an opportunity to sell, so they sell the stock. They dump the stock during the day. Okay, this is what happens most of the times. Okay, so a stock will open above the yellow line, you get excited, you buy the stock, and then it starts to pull back, making you lose money in a very short period of time. Now, that is not what happened here, but it happens most of the time when a stock opens above the yellow line. So what has this got to do with the mango example? Well, if you have experience in trading, if you have bought enough number of extended stocks in the past, you will know what the experience is like. And there is a very high probability that the experience has not been good. In fact, David Ryan, who has been a 3 time US investing champion, he was in the habit of buying extended stocks. And over a period of time, as he analyzed his past results, he realized that the decline in his performance was because he was buying extended stocks. So when you buy enough number of extended stocks, you will automatically come to know that the experience in general is not good. Now in this stock, the experience has been good, and the market still has 3 4 hours to go, so this could collapse anytime. Okay, I don't know. Some stocks will open above the yellow band and will shoot up from there. Most of the stocks will open above the yellow line and then crash back into the base, causing you a loss in a very short period of time. That is why I say this is my rule. If a stock is extended above the yellow line, don't buy the stock. You are taking too much risk. See, ideally, you should be buying stocks when they open properly below the yellow line. See, this is the breakouts. Open below the yellow line, then start crossing. So it's like you go to the railway station, you stand at the platform, you allow the train to come, you allow the train to stop, then you get on board the train, and then the train starts to leave. That's a proper way of entering the stock. But imagine you go to the railway station, the train is coming very fast, and you try to jump onto a fast moving train. Okay, you will end up breaking your bones. You have to allow the train to stop at the railway station. Okay, similarly, you have to allow the stock to open below the yellow line, cross the yellow band, give you some time like 5 10 minutes to enter the stock while it is inside the yellow band, and then get a proper trade execution entry. Okay, but if you get a wild move like this, if you get a wild move like this early morning, and if you try to jump onto the stock, you might find yourself, okay, breaking your bones. You might buy here, and then it would crash back down. That happens more often than you think if you study the past breakouts which have opened above the yellow line. I'm not saying that the stock cannot go up. I'm just saying that there is too much risk when you buy an extended stock. So the moral of the story is, if the stock is extended beyond the yellow line, don't buy. Okay, you are buying an extended stock. That is a mistake. If the stock is below the yellow line, okay, it's not crossed yet, don't buy, because you are buying a premature stock. So both of them are mistake. Buying an extended stock and buying a premature stock, both of them are a mistake. So don't fall into that trap. Your trade execution price should be exactly between these two yellow lines. Okay, not above, not below. That's the proper way to take a trade entry. So coming back to that mango example, if you have eaten enough mangoes in the past, and if I ask you to close your eyes, and if I give you a piece of mango, you eat it, there is a very good chance you will know that it was a mango. Okay. Similarly, if you have bought enough extended stocks, I have personally bought enough extended stocks in the past to inform you that buying an extended stock is not a good idea. It doesn't give you a good experience. Okay. So a lot of students ask me, Rohit, why do you don't buy a stock if it opens above the yellow line? Okay. I say my experience has not been great. So that is why I avoid that risk. Now, a stock might open inside the yellow band. Now, can you buy? Of course, you can buy because it is in our buying range. So, although it opens above the first yellow line, but it is still not extended too much. So, I can still buy, but then I have to micromanage the trade because the stock has shot up in the morning. It could be a flash in the pan. Remember, if the stock shoots up, it creates a rising window in the morning itself. Okay, it could be a flash in the pan. So avoid flash in the pan. Okay, remember this mango example, very important. I am telling you from my experience, do not buy extended stock. So this is a stock which was on my list, technically fundamentally strong, but I still haven't made a purchase because it is extended. I don't want to take unnecessary risk. So I hope this video has added value to your trading journey. Let me know what you feel about it. Please like, comment, and share this video so that this video reaches those people who genuinely want to become professional stock traders. Thank you for your support on this YouTube channel. Thank you so much for your time. If you have any questions or doubts related to extended stocks, just send me an email, connect with me on WhatsApp. I will quickly respond with a voice message. Thank you so much.